Property and casualty has a broad range of insurance options. The property side mainly deals with damage done to property owned by a client. On the other hand, casualty is concerned with losses incurred when the insured injures a person or damages another's property. We also refer to it as liability coverage. Paying a claim for covered losses is referred to as indemnifying the insured. It essentially means the insured will be placed in the same relative financial position they were prior to a loss. Another important concept is that of insurable interest. A person wanting to insure an object must have a financial interest in the object. So, if you borrow a friend's car and wreck it, the person who's financially affected is the owner. That's who has the insurable interest. Issuing policies involves underwriting. For this discussion, underwriting is the process where the insurer examines the risks associated with the insured to determine the correct level of coverage and premium for a policy. We also explored sources of information available to the producer or underwriter. This might include applications, credit reports, and an actual inspection of the proposed insured property. Then we looked at loss ratios. These are measures of premium dollars paid to the insurer compared to the amount of loss dollars paid in claims. With loss ratios, lower is better, so a 60% loss ratio is better than 90. Evaluating hazards is also part of the underwriting process. And if the insurer finds certain hazards present, the likelihood of issuance drops significantly. We also examined other factors that determine premium rates. The course discussed initial aspects of negligence and then expanded those aspects throughout the lesson. The segment explored defenses against negligence, including intervening and superseding causes and assumption of risk. Pay close attention to these terms and concepts. They can get confusing at times. The lesson explained types of liability, such as absolute or strict liability, which is the most restrictive form of liability to owners of properties with certain inherently dangerous attributes, like wild animal parks or commercial aviation risks. Other liability concerns are things like vicarious and imputed liability, contributory and comparative negligence, assumption of risk, and statutes of limitations. The idea of proximate cause and its associated implications was then presented. Blanket and specific insurance was considered and included the potential for a margin clause to be attached to higher risk, non-standard contracts, which limits the recovery amount in certain situations. We also defined the structure of insurance policies and the four main components of a contract. Remember the acronym DICE: Declarations, Insuring Agreement, Conditions, and Exclusions. The section made clear certain no-fault benefits, like medical payments, and finished with an important material on endorsements, which are used to alter coverage in a policy, and supplementary benefits included in the contracts. We defined insureds and the provisions that affect them and the differences between them. There are first named insureds, who control the contract, and then other insureds that are covered by the policy. We looked at policy periods and what a deductible is. This finished with a detailed explanation of how coinsurance works in P&C. It also explained coinsurance penalties that would be assessed on a claim if the property is underinsured and doesn't meet requirements. It's never a good thing when a client is penalized due to insufficient coverage. You, the producer, must make sure your clients are aware of what could occur if a property doesn't have enough coverage. This portion finished with a look at assignment and abandonment, neither of which are allowed without the insurer's permission in writing. Cancellation and non-renewal provisions were then explored, and we explained the processes for premium refunds and how they're calculated. Additional material covered deductibles and situations in which more than one insurance policy covers a loss. Review concurrent and non-concurrent policies and make sure you're familiar with their differences and how insurers coordinate benefits when there's more than one effective policy. This section concluded with a discussion on the different types of liability insurance limits, such as split or combined single limit, and that many commercial insurance policies provide per occurrence and aggregate policy limits. The lesson's last section worked with certain insurer provisions that tend to benefit the insured parties, such as liberalization. This provision automatically adjusts the coverage of a policy to meet legal obligations and newly enacted legislation that affects coverage. Then we introduce you to subrogation, the process by which the legally responsible party, typically the at-fault person's insurance company, will ultimately have to pay for a loss. We looked at claims options, the insurance company's duty to defend, and how arbitration procedures work. Finally, the lesson finished with information regarding how third parties, like lending institutions with an interest in the insured property, may be protected through property insurance. Conversely, you also learned that a third party might not be protected by an insured's policy under the no benefit to bailee provision.